Hello, friends, and welcome to another webcast from Edge by Ascential. My name is Tom Mariani. I'm a member of the marketing team here at Edge, and today we're going to talk cross-border omni-channel retail. Joining me on the line today from sunny Madrid, we have one of our very own e-commerce and omni-channel experts, Gemma Pinedo. This webcast is brought to you by Edge by Ascential, the data, insights, and advisory solution you need to win in an e-commerce driven world. Formerly BrandView, Clavis Insight, One Click Retail, and Planet Retail RNG, our four companies have joined forces under Ascential PLC with a shared vision to empower brands and retailers with the most comprehensive, accurate, and actionable insights and advisory solutions to grow revenue in an e-commerce driven marketplace. We partner globally with the world's leading brands and retailers to identify strategies and to provide weekly, daily, and real-time digital shelf performance KPIs, including pricing, promotions, availability, traffic, conversion, sales, and share. Gemma Pinedo leads Edge by Ascential's e-commerce advisory practice in EMEA. Prior to joining Edge, Gemma worked for Kimberly-Clark for 11 years, where she most recently led their digital strategy and e-commerce business development for EMEA. In this role, she was responsible for driving e-commerce revenue growth by expanding online distribution through strategic partnerships and commercial relationships with online retailers, industry players, and digital media and other platforms. Also, please submit any questions you may have for us during the presentation. All participants are on mute for the call, but you can ask your questions by typing them into the Q&A box on the right-hand corner of your screen, and we will try to follow up individually with as many questions as we can after the webcast via email. And lastly, in addition to our virtual webcast, we have an awesome schedule of in-person events and programs that we want to share with you. Our fall slate of e-hackathons has been released, registration is open, and tickets are for sale. For those of you in the EMEA region, we're pleased to announce our e-hackathon London on October 22nd and 23rd is open for early bird registration. This is an exclusive 2-day Amazon and omni-channel focused e-commerce centric summit with day 1 covering Amazon and day 2 covering omni-channel and digital shelf optimization. Our e-hackathons are overflowing with amazing interactive content, including brand case studies, the latest perspective on Amazon, and strategies to perfect your digital shelf, and of course, our Hack Shop Masterclass sessions. These events are also great learning opportunities for your entire team, and group discounts are available. Our March event in Bentonville sold out, so don't let this opportunity pass you by. You can register by either reaching out to your Edge partners or directly via our website, where you'll find it and all of our hackathons listed under the events tab. And now we can get started. Gemma, take it away.
Thank you, Thomas. And hi, good morning, afternoon to everyone. I'm Gemma Pinedo, and it's my pleasure to host today's webinar on how to leverage cross-border e-commerce as a window of growth opportunity. Over the next 5 years, e-commerce will be the fastest growing retail channel, and it will grow 3 times faster than the store base. Due to the high fixed cost nature of e-commerce, scale is a critical part of achieving favorable economics online. And it's because of that the global landscape is expected to further consolidate, resulting into a few borderless e-commerce operators, which will present a supply chain and pricing challenge that potentially represents a barrier to grow profitably for brands. Today we will talk about why scale matters and how this will influence the future landscape, what is cross-border trading, and how to approach in an efficient way. In an e-commerce driven world, the e-commerce of the future is mobile driven, and the proliferation of mobile phones has increased internet penetration, which has led to an increased digital addressable population. Mobile routes to internet are rapidly expanding internet access, driving awareness of brands, products, and services around the world. And it's also enabling ubiquitous connectivity, driving shoppers' insights, and giving more access to information, increasing consumer expectations around speed, convenience, and personalization. The consumer is now in control, and ubiquitous connectivity allows consumers to compare products, increasing transparency and making well-informed purchase decisions. If you can go into the next slide, please. The consumer is the previous one, please. The consumer is in the driving seat, becoming very demanding in terms of what, how, and where to shop, leading to an on-demand consumer. On the other hand, e-commerce will be the fastest growing channel, significantly disrupting the order of retail. In fact, by 2023, e-commerce will account for almost 30% of all retail sales, up from 18% back in 2017. This ongoing shift of retail sales online is really disrupting established business models, and is forcing both brands and retailers to rethink their investments and how to shift investment away from physical store-based business models into building digital capabilities. It's also increasing complexity in terms of logistics and fulfillment needs, requiring new capabilities to serve both the on-demand retailers as well as the on-demand consumers. Within e-commerce, marketplaces will be the growth engine. In fact, if we look at global players, 9 out of 10 operate a 3P marketplace model. If we think about the likes of Alibaba, 99% of the revenues, they come from marketplaces. However, Amazon started as a first-party business model, and already more than 50% of the revenues, they come from marketplaces. And this trend will continue because within e-commerce, marketplaces is far more profitable business model, given the asset light nature of it, and less capital intensive requirements for retailers. In e-commerce, economics is the real challenge to solve for. If we compare e-commerce versus store-based retailers P&L, store-based retailers still tend to generate higher margins, and this is due to significant fulfillment costs associated with online operations, especially across grocery. Under this scenario, scale really matters and helps to absorb the high fixed cost nature of online operations, and it helps to drive also better economics. So how are retailers achieving global scale? Retailers looking at building scale are entering new geographies and building supply chain capabilities to expand reach. If we think about the likes of Amazon, they obviously they started in the US, but now they are looking into Europe as a must-win geography, and also expanding into Asia Pacific. The same happens with Alibaba, where they started back in China, and now they are moving and expanding into Europe. This geographic expansion is facilitating cross-border e-commerce. It also makes differences more visible, hence increasing competition. So here the ability to grow cross-border will be a large point of disruption. Global connectivity has opened up opportunities for brands and retailers to win new customers overseas. And the continued rise of 3P marketplaces platforms connecting sellers with customers around the world will grow the digital addressable population. By 2020, cross-border e-commerce will reach $992 billion, or 20% share of total e-commerce. So the growth of cross-border e-commerce is really driven by three major factors. Number one, shoppers increase expectations, looking into buy products that they do not exist in the home country, or maybe they are more expensive. The second reason is retailers and brands desire to sell more internationally. And the third one will be retailers looking at market dynamics, searching for price arbitrage opportunities to drive better profitability. Under this scenario, brands will find themselves managing brands, portfolios, pricing strategies, and supply chain across the board. And if they don't have a comprehensive strategy, this will impact their ability to grow profitably. In today's session, we will focus on the very last one, the impact of price arbitrage, and what strategies we need to put into place to overcome this challenge. When we look at Europe, Amazon is the main driver behind cross-border sourcing. Amazon is looking at leveraging Europe's different market dynamics to drive profitability at the cost of manufacturers. However, as we saw, retailers looking at building a scale and entering new geographies to reach new consumers, the same cross-border sourcing principles will also apply to other regions. So what is cross-border sourcing? So cross-border sourcing is the sourcing of a product, very simplistic, for reselling one market by a retailer from another market. Let's illustrate this with an example. Typically, a given supplier trading with Amazon across different markets will have different pricing strategies in each market based on local market dynamics. Let's think about a German shopper who logs into Amazon.de and places an order. Amazon searches its price system and notes that actually sourcing from the Spanish warehouse is cheaper than sourcing locally from Germany. Amazon will then go and fulfill the order to the German shopper from Spain. Pricing arbitrage is at the core of Amazon's sourcing strategy. Amazon will source from whatever is the cheapest on display. And there are actually 4 points of sourcing for Amazon typically. They can source directly from the manufacturer. This is what we often refer as first party. They can source from second parties like distributors, wholesalers. This is what we typically refer as third parties. They can source still from the manufacturer, but from another market. And this is an algorithm-driven pricing system, which for Europe is called the European Fulfillment Network. And last but not least, they can source from a single point of sourcing. This relates more to global contracts, like the likes of private label. Amazon is one of the fastest growing online players across the world, and this really represents a significant opportunity for manufacturers looking to grow their e-commerce business. However, trading with Amazon, and given the cross-border nature of their operations, this means that manufacturers will often find themselves managing a brand, a portfolio, assortment, pricing, and supply chains across multiple countries. And not having a comprehensive go-to-market strategy that oversees operations across the board will limit manufacturers' ability to grow profitably. If we reflect on our example, and we think about that price arbitrage between Germany and Spain, this leads to Amazon to source cheaper from Spain, and hence the manufacturer, the supplier, will see how their business, although it grows with Amazon, it loses margins. In this particular example, it will lose 500 basis points in Germany to Amazon, who, using price arbitrage as part of their sourcing strategy, it's able to drive their own profitability at the cost of the manufacturer. In this price comparison exercise, terms and conditions and the overall trade margin has significant implications on pricing strategy. It is fundamental to understand pricing structures across markets and have full visibility on net prices that Amazon uses for comparison purposes. Here, our recommendation will be for manufacturers that operate across multiple geographies to hold monthly reviews across markets and make sure that local markets have full visibility of the pricing structures, the terms and conditions across other markets, so they can make more informed decisions in their negotiations with Amazon. So what are the major challenges for suppliers driven by cross-border sourcing? Well, there are fundamentally 5 pain points that this sourcing strategy creates disruption for manufacturers. The first one is when it comes to forecasted demand. Forecast of demand with Amazon is based on past performance. In our example, if we assume that the German business is bigger than the Spanish business, the forecasted demand for German will be higher than for Spain. The second implication and pain point, it comes with working capital levels and inventory levels to match the forecasted demand and to support the forecasted demand. Then the third implication is when it comes to investments to drive demand. So we have forecasted demand, we have built the stock, and now we need to drive investments to sell it. So hence, investment levels for Germany will be higher than investment levels for Spain to support that forecasted demand. The fourth pain point is when actual demand comes in, and then there is a mismatch between forecasted and actual demand. Here we'll start to see how stocks build up in the German warehouse, whereas Spain will run out of stock. And then last but not least, and most importantly, selling to Amazon at lower prices and hence diluting suppliers' business with Amazon. So again, in our example, even though we still sell to Amazon, we will be selling at lower prices, hence lower margins, which ultimately it will dilute our overall business with Amazon. So what are the strategies to approach cross-border sourcing? If we think about it, there are 4 main strategies, and it's not one or the other, but you can actually combine them depending on your business specifics, your portfolio, or really where you are, where there are your main pain points. Thinking about those strategies, we can highlight 4 of them as the key ones. The first one is around price harmonization across markets. The second one is on dedicated channel strategy, and these 2 are kind of very related to each other. The third one is moving into a centralized org structure with a centralized P&L. And then the fourth one will be how to leverage marketplaces, either by partnering with existing third parties or as part of your go-to-market strategy, becoming a third-party seller yourself. So let's start with price harmonization. In our example, this will simply involve moving all markets to same price structure. We will all markets will move under the 10 euro list price with Amazon. Under the harmonized price structure, Amazon has no incentive whatsoever to source from a different country. This effort requires companies to take into account many financial factors, such as margins, taxes, exchange rates, in order to arrive to a single price. Harmonization needs to happen under certain principles, and it needs to have some reasoning behind, as it might not need to harmonize across the border. So some of those criteria when you decide on harmonization that you need to bear in mind, it's year of proximity. So there might be a threshold in terms of supply chain cost below which, you know, cross-border trading doesn't make much sense. So typically it stands around 15 to 20% price gap, for which cross-border trading doesn't make sense. You might also want to consider the local and the cultural needs. So if we think about Europe, what we have observed is that there tends to be a flow of cross-border trading between Southern European markets, so France, Italy, and Spain, and then more sort of North Europe, UK and Germany. Currency and exchange rate is another factor that you need to bear in mind. So there has been times in which, given exchange rate factors, there was a huge flow of cross-border trading from Germany into the UK, but now it's the other way around. Some exchange rate factors might be driven that flow of cross-border. And then last but not least, what are the legal barriers? But as we harmonize prices for a given retailer, this can potentially have a knock-on effect on other channels. As we think about it, harmonization of prices will mean that for some markets we'll have to increase prices, whereas for others we might have to reduce prices for a given retailer. And this will have a knock-on effect on the other retailers. One way to overcome this price comparison is by creating retailer-specific SKUs across the region that are not in direct competition with the local assortment. We don't need to go too complicated in terms of creating retailer-specific SKUs across the full portfolio. It's enough to focus on those SKUs that are very relevant, either because they are fast-selling items or because they have margin challenge issues, or they are high profit margin items. So typically, if we think about the likes of Amazon will favor those SKUs that have more velocity, hence fast selling items. Also, in their profitability criteria, and before delisting a given SKU because they cannot realize any profit, they might go into the European fulfillment network to look for other alternatives within other countries for a given manufacturer to see if they can source cheaper from those markets. And then obviously for the high profit margin item, price arbitrage, it's also appealing. So those will be the three clusters that we will focus as we think about harmonizing, about creating a standalone retailer-specific SKUs. Here we have some examples on how retailers, how to create retailer-specific SKUs. We don't need to go all the way back to rethink manufacturing. It's simply enough maybe doing different pack configurations or even adding some add-on items that creates and makes them a different SKU, different items, so it won't be able to compare prices. In this example, Nature Valley has successfully executed packaging differentiation across its different channels. So the third strategy when it comes to overcome cross-border sourcing issues is rethink your org structure and moving from a centralized into from a local account into a centralized business model, both in terms of org structure as well as one single profit and loss account. Under one centralized structure, roles and responsibilities need to be shifted between local teams and one central regional team that oversees all the major functions of the business when it comes to sales, finance, marketing, and operations. It's almost like creating a segregation of duties where the central team will be more focused on the strategics of the business, whereas the local team will almost focus on the activation and the selling. In our example, if we and by the way, moving from a siloed org structure into a central regional team also has implications in terms of how to measure the business and the KPIs, and ultimately we will be looking at creating a standalone P&L for this given account. If we think about our example, and if we think about the levels of forecasted demand, the levels of inventory, and the investments that the German business had to put behind to drive that demand, that will ultimately shrink their KPIs and the financials. On the other hand, we will have the sales P&L with the Spanish P&L with the sales uplift. So ultimately, you will see a mismatch in terms of financials and KPIs, and this typically creates a lot of disruption across markets. So hence, moving everything under the same roof, the same P&L structure and the same financials takes away that disruption. Here, my recommendation will be to really and truly understand first the dollar value of that cross-border trading before moving into this org structure, which it can create a lot of disruption, but certainly creates a lot of internal noise as well. And then the fourth strategy when it comes to overcome cross-border trading, it's how to leverage marketplaces. marketplaces platforms. If we think about the traditional route to market, the brand will sell to Amazon in this example, and then Amazon overtakes the business, and the brand loses really control of their business. A marketplace aggregates sellers and shoppers, and the beauty of a third-party seller is that they can influence and be in the driving seat of their business. They can influence pricing, they can influence margins, they can influence sourcing and distribution. As a third-party seller, brands keep more control of the end-to-end of the value chain. If we compare three typical business models, direct to consumer versus first-party marketplaces versus third-party marketplaces, and we try to understand where ownership of the business lies across the value chain, we can see that both direct to consumer and marketplaces tend to have more control of their business destiny. Whereas in a marketplace, in a first-party marketplace business model, once the brand sells to their retailer, the retailer overtakes control of the business. So some of the benefits of going and choosing third-party marketplaces as a go-to-market strategy, as we already referred, we have more access to margin. We can create in-stock buffers. We control our inventory levels. It's a great way to have first-hand contact with consumers, consumers' feedback that ultimately can feed into a new product development. We have pricing influence. It allows us to build in-house capabilities, and last but not least, to have access to end consumer. So when we think about cross-border, these are the questions that we need to ask ourselves. As much as cross-border trading, cross-border e-commerce could potentially create disruption to our business and create some challenges, it also creates great growth opportunities, as we saw in the introduction, because of how global retailers are evolving, how they are looking to reach that scale to drive better economics, the platforms and ecosystems they are creating. This all it's facilitating cross-border e-commerce. So we need to ask ourselves as manufacturers and brands, how are we leveraging the cross-border e-commerce opportunities? Are we actually making the most out of it, or are we facing it as an internal challenge? Do we have a consistent strategy when it comes to portfolio offering, brand, pricing strategy, and supply chain capabilities that will allow us to grow profitably? Do we have full visibility in what are the price structure across multiple geographies? And most important, do the different countries have visibility into other countries' pricing structures and terms and conditions? This will ultimately give them a point of leverage in their negotiations. In the past, Amazon used to take a very silo approach in their negotiations, and it was pretty much locally driven. However, as Amazon is transitioning, is starting to realize the opportunities of not just price arbitrage, but economies of scale, and is taking an approach of having visibility across the board and starting to leverage the best of each market. Let's make sure that as suppliers to Amazon, we have the same internal visibility. And most importantly, what are the implications of cross-border on other channels? Do we have a clean channel strategy? What does it mean for us? As Amazon keeps growing, other retailers are starting to shift their attention, so hence price comparisons. So yeah, all these questions that we need to ask ourselves when it comes to cross-border as a source of growth opportunity. And just as a wrap up, I want to leave you with some examples on how Edge by Ascential helps brands navigate cross-border omnichannel retail. The first one, it's around business development. So as we already mentioned, cross-border e-commerce is growing very fast. It's going to take 20% share of overall e-commerce, with e-commerce being the fastest growing channel. So what are the opportunities out there in terms of business development? Do we know what could be the size of price for our brand in terms of cross-border opportunities? As consumers, we talk about being in the driving seat and becoming very demanding in terms of expectations and searching for products that maybe they cannot find in their home country. Are we, as brands, are we truly leveraging those opportunities? And do we know what sort of markets we need to prioritize? I shared on the slide through the deck where US and China obviously led the way in terms of e-commerce cross-border e-commerce opportunities in terms of size of price, but Europe is following very shortly because of the influence of Amazon. So where do you need to put your capabilities? What markets do you need to prioritize? The second area where we work with brands like you, it's around building go-to-market strategies. So what sort of portfolio we need to put in place? What pricing that gives us the margin levels that are within our corporate objectives? What are the supply chains that we need to put also in place to win in a cross-border e-commerce world? What are the different price points and the different assortment that you need to use as a go-to-market strategy? The third one will be around strategic partnerships. We talk about the beauty of going into marketplaces. Either you can do that either by yourself, or by partnering with external and existing third parties. In one way or the other, the beauty of third-party marketplaces is that you keep control of your destiny. You have more price, margin, in-stock influence, key variables to drive your business forward. And as I said, you can do that by yourself, which will require building certain capabilities from scratch, particularly in the area of supply chain, because ultimately you own the obligation to deliver to the end consumer. Or ultimately you can partner with an existing third party seller, which it has enough credibility given their history, their portfolio, and their credentials, as well as the capabilities that you can leverage. And you can build strategic partnerships to drive parts of your business through third-party marketplaces. Again, it's not one size fits all. I'm not saying one black or white. I'm saying that you need to understand the stage of your portfolio, and it will be parts of your portfolio that you might decide to go as a third party and partnering with existing sellers. And then the fourth one will be around areas where we support our clients on organizational structures. So how to move from a siloed account management to a regional approach. What are the roles and responsibilities that sit within local versus regional? How to create that strategic mindset within the regional team, whereas how to give the tools and capabilities to the local teams to focus on ultimately driving sales and driving top line performance. With that, we might want to open for questions.
Actually, Gemma, I'm not sure if we have time for questions now, but as always, when we don't have time for the question on the live broadcast, we will do our best to follow up with as many questions that you guys submitted as we can after the webcast directly, individually. So I think that about wraps us up for today. Thanks so much, Gemma. A lot of really great stuff. Good content, so appreciate you jumping on and joining us here today. And of course, we'll also send a copy of the video recording and also a PDF file of the presentation deck to all of you that you can download on demand. You know, if you're joining us from America, it's a little bit earlier than usual. Maybe you missed the first few minutes. Not to worry. As always, we'll send you the video and the presentation deck itself. And finally, thanks to all of you for taking the time and joining us here this morning. And from all of us here at Edge, have a good rest of your day and a great rest of your week. See you next time.